Good morning, ladies and gentlemen. I'd like to call this hearing to order in the knowledge that we're in Treaty 1 territory and the home and the traditional lands of the Ojibwe, the Cree, Dakota peoples, and the national homeland of the Red River Métis. Our drinking water comes from Shore Lake 40 First Nation in Treaty 3 territory. My name is Ron Merritt. I'll be your chairperson this morning. Introducing to my right is this Dan Nesbitt, and via Zoom, panel member, Mr. Ian Mahone. Our recording secretary is Stephen Lunn, and representing the city of Winnipeg is Matthew Barosik. This morning we'll be hearing application of revision for the assessment role according with the Municipal Assessment Act. The matters for which revision is requested and described in each application, and will limit discussions to those matters. The statements that are made in this hearing are sworn testimony, and anybody speaking in these matters must be sworn in. Please be advised that comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. The board is appointed annually by City Council and is independent. Along with the city administration, we make our decisions based on the evidence provided at this hearing and issue a written order that will be mailed to all parties as soon as possible. Please note the decision by the board in respect to the application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value, the assessed value or classification, or to Court of King's Bench if the matter pertains to application of exemption from taxation. Should you wish to appeal, the information on how to do so will be included in the board's order. With respect to the hearing this morning, I will confirm the points of appeal with your property to be addressed with each the applicant following the swearing in. We'll then have the assessor's testimony followed by questions that the applicant may have. Then will be the applicant's testimony followed by questions. Each party will have the opportunity to summarize if they wish. Once all evidence about the application is brought forward, the applicant may leave. The process will repeat for each item on the docket this morning. The session will close after all applications have been heard, and the board will deliberate in private and make its decisions. You will receive the board order decision by registered mail as soon as possible. As information, all public hearings are live stream recorded and will be part of the public record. We'll be hearing this morning items 2, 3, 5, and 6. I ask your secretary, Mr. Lunn, to affirm the assessor and to swear in the applicants. Mr. Lunn.
Mr. Assessor, please state your full name.
Matthew Rogas.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes.
Thank you. Mr. Story, please stand. Please state your full name.
Jared Story.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes, I do.
Thank you. You may be seated. Mr. Navarro, please state your full name.
Marcelo Navarro.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
All right, gentlemen, the first item that we have on the docket is 433 Main Street, and the reference or the year for the 2022. Mr. Story, I understand that you will be going first, so the floor will be directed to the assessor, Mr. Brockus. Whenever you're ready, you can take us through this property. Okay.
Okay, thank you very much.
Oh,
File
sorry.
23-361. Roll number 13060750100 433 Main Street. It's a Res Am building, so it's a mixed commercial apartment on the southeast corner of Bannatyne and Main Street. We've got two roles, rather two classifications here, evaluation. We've got the residential at 16,068,000, and then we have the commercial at 4,325,000. Total value 20,393,000. 14 stories. Actual year built 1976. We don't have an effective year built on it on this brief, which I find strange because it had undergone a significant amount of renovations. There's 94 suites in the building. So what it used to be entirely commercial. But what they did is they renovated floors 5 through 14 and turned them into apartments. There's some pictures later on in my brief you'll see when we get there. I know the applicant and I, we discussed this property ahead of time. I don't, to my knowledge, currently right now, we've come to an agreement on the valuation for the residential portion, so I won't spend too much time on that. I think it's just the commercial 60 other classification that remains in dispute. So you can see on page 2, they've been compliant with submitting their mailers. Subject sale history, this is actually after the reference date, so I'm not gonna regard that for this particular assessment here. It also reflects the prior to the renovation, so it doesn't reflect the asset that we're actually valuing here this morning. So page 3 shows the income value summary. We've got 41 bedroom, 54 2 bedroom, 94 units in total, 1,400 rounded on the average monthly rent. For the residential, with a 5.25 cap and a 44.93 expense ratio, generates an estimated market value of $16,068,000. Then we've got our office. We've got our office stream right here, and what we see is, pardon me, let me check this. What we see is that we got 9% vacancy, $11 shortfall, $2 expense ratio. These are all modeled figures, and a cap rate of 6 3/4 as per the model. Estimated market value $4,325,000. On the following page, it just shows a breakdown of the market income. So the rent per square foot, the net rent that we're assigning for this, the model's assigning for this reference here, looks like it's in the $11 to $12 range predominantly, other than that smaller unit that we've got $14.15 on the potential rents. So on the page after that, we've got our rent comparables, and these are just some that were pulled from around the general downtown area. Again, we came to an agreement, and that agreement is reflected in the current assessment for the class code 20. So I'm not going to dwell on this for too long, but Evergreen and River, they are in the Osborne Village area. Smith is in the South Portage area. And Wilmot, you can see it's a bit different from a story perspective. It's lower, and it's got a rent of $13.11 on it. So then I pulled some suburban rents too, just to show generally what newer builds are renting for. The units are newer. They've been freshly renovated, so they're essentially new, what the tenants would be comparing against from an interior perspective. So while there isn't a whole bunch downtown, I did go to the suburbs. Here's the list of the rents here. They're pretty self-explanatory. I'm not going to go through them, and I don't anticipate much dispute on this class code. Here's the comparable leases on the next page. Just some general downtown leases. So just pulled ones of similar square footage. And you can see they have varying effective year builds, mostly in the 70s, which is reflective of the overall vintage of our building. I talked to the inspector and the person who processed this supplementary notice. They let me know, they said that the office space hasn't been renovated. They say it remains as it was. It was just the residential portion that is new, so to speak, as they converted the former office into apartments. So you see on the net rent here, the comparables that are pulled in the general exchange district area. They support the model rents, so that's where the model would be pulling, generating the rents for this property. Got cap rates, general cap rate table you've seen 1,000 times, and scrolling on further down the line, we get to the pictures. So the pictures here, you can see the outside of the building. It's actually right next door to our building. So they did some work on the outside, on the exterior, and a description of the new luxury apartments. And as you scroll through, you can see what I'm talking about when as I describe it, they're basically new on the inside. And then at the end, we've got a lease from Capital Commercial Real Estate, just showing how they're describing the area to potential lessees and the attractiveness of the area in regards to its relative location close to Portage and Main in the Exchange District, so on and so forth. Lots of foot traffic, lots of business during the day, people going to and from. And then just a general table. And then some floor, and I included one floor plan of office area. So the parameters for the commercial were modeled. The applicant and I did come to an agreement on the residential too. So unless anything's changed, I don't see any dispute coming our way for that classification. That's my evidence. Thank you.
Thank you. Mr. Story, questions of the assessor?
Well, I'm going to turn it over to Mr. Navarro. We do agree on the multifamily, so Mr. Navarro will handle the office portions.
Mr. Navarro?
Okay, Mr. Brokus, regarding the classification of the property, it's been classified as Class B office building, correct?
Yep.
Okay. Prior to the redevelopment of the property, it was a 14 story Class B, correct?
I believe that's the case, yes.
Okay. So effectively, we've taken off about 9 stories or so. And
That would, yeah.
is it still a Class B?
That's what Class B, that's what we have on file, yeah.
Okay. Do you know how that is determined?
No, I think, I believe it has to do with the area that it's in, that's taken into consideration. We're trying to assign classifications to suit the quality of the area that they're in. So
Okay,
while most of it is apartment now, that the commercial that is in there now is in a really good spot. I don't think we can really, at least I think in my opinion, I think that's the general opinion too.
So just based on that comment that you just made, would you not agree that most of the office buildings in this area are actually Class C and D?
I don't have that information in my brief, so I can't answer that question conclusively.
Okay, you do realize that many of the office buildings in this area are slightly older, correct?
It's the Exchange District.
Okay. Now, in terms of the rents that you supplied here, did you inspect any of those properties, or have you had an opportunity to inspect any of those properties?
The commercial ones?
Yeah.
No, I have not.
Would you be able to indicate which ones are actually connected to the walkway system, if any?
No, I don't have that information in my brief.
Okay. Now, in terms of the non-recoverable expense allowance that you put on there, you put in a total of 3%, correct?
Yeah, that was what the model assigned to it. That's
Okay.
what commercial, pardon me.
Now,
For the expense rate, the non-recoverable is 2% for this one, I believe. I think
I believe it's 3%.
Is it? You're talking about the expense ratio?
No, this would be what we consider non-recoverable expenses.
Like on my page, let me see here. 1, 2, 3. That's what I see like expenses as 2% there. I don't see 3%. I see vacancy for the apartment.
Okay, what page are you on?
I'm on the third page. 1, 2, 3. The income value, it says income value summary at the top.
And we are dealing with the 2023.
No, the 2022.
22. Mr. Barrett. You said 20.
No, I know, I realize that.
Okay. 2023. Okay, so you've got 2% there. Previously, we know that there was actually 7% there, correct?
I mean, on this page, I've never seen 7% appear in that field.
Okay, we'll go with 7% because I think everybody knows that previously there was 7% on there, but do you
Like
have
previously, as in like last cycle?
Joe, this would have been for the 2018 assessment cycle. So we're dealing with the 2020 right now. So for the 2018, there was historically 7% there, and I believe probably going back 20 years or so, there was 7% there. Can you explain how the city came to this judgment on changing the non-recoverables?
To my knowledge, we did research in regards to the income and expense statements received by commercial tenants as we put out income and expense mailers every year, and it was determined that the rate was 2%, not 7%.
Okay, and you've provided no information to support that position, correct?
No, I don't have that brief. That's what all the commercial premises are getting from, I mean, that's what they're all getting. So I don't know what you want me to say here. I don't have any evidence where it's done by the model.
And in terms of the cap rate, do you have any information other than the chart on page 8 as to how the cap rate was derived?
No, I do not.
Okay. Now I'll turn to your, let's see, page 19. Okay. So your page 19 at the bottom suggests a gross rent of $25 per square foot, correct?
That is the from the lease. That's what Capital is putting out, 25 gross.
So that's being advertised as their market rent, their gross market rent, correct?
That's what it says.
Okay, and the gross rent would be basically the net rent and any additional rent, correct?
Well, yeah, it would be like including like cost to occupy, all covered by the owner. That's why it's higher.
Right. So you would include in there, for example, additional rent of CAM and taxes.
Yeah, yeah.
Okay. Okay.
I'm not saying it should be 25. It'd be a lot easier if they gave us the net rate, but they didn't.
Okay.
This was more of a table showing kind of like what was involved
Right
in the property details. I didn't put any weight, if for the record, I didn't put any weight on this where it says $25 per square foot. Based on the comparables, that wouldn't be reflective of net. So it doesn't really mean anything to me.
Right. But that is an asking rent, correct?
They're just asking it, yeah.
Okay, and they wouldn't necessarily always achieve asking rent, correct?
I'm sure they'd negotiate the potential tenant would,
Okay.
so that's just a sticker price.
Okay, Mr. Story, do you have any other questions?
No, I think you covered it.
Okay,
Thank you. Ms. Nesbitt, questions of the assessor?
Matthew, did you indicate that the vacancy rate of 9% is also a model rate?
It is, yes.
And is that based on age or what is that?
Let me pull this up here. It would just be based on the area.
Area? Okay. And can you give us a little bit more information on the 6.75 cap rate? You indicated it was model. In looking at your chart, can you explain how it all fits in?
One moment here.
That just the downtown B rate that you've that the model has chosen?
Sorry, one moment here. Yeah, I mean, it's 6.75 across the board here. So I don't have any cap rate sales or information to substantiate it on a more stabilized, comparable basis. But based on the data that we've received, that's the cap rate that the model is assigned for properties of this quality in this area. Sorry, I wish I could have more, but I don't. Okay. I don't have more to answer that
question. You might not be able to answer this though, but I'll ask it anyway. Mr. Navarro has suggested that this might not be a B office, more likely a C or even a D. What would happen to the cap rate in those instances?
From the model perspective, well, I mean, I don't agree with that contention. Okay. Like if you look at the pictures, you look at the location, you're not too far from Portage and Main. You're in an attractive area for foot traffic. I wouldn't agree. I mean, pictures say 1,000 words, right? So I don't know what it would do if I flipped it to a C or a D in our model, but I wouldn't be doing the flipping and hitting approve on that one.
Okay, so you've indicated that you disagree that it would be a C or a D. You said based on pictures, but I mean, I know you've been through the building. So what would define it to be a B in your mind versus a C or a D?
I mean, the quality of the location and I would really put a lot of weight on that. You know, it's really close to Portage and Main. You can see they did a whole bunch of work. They're leased up. I mean, pretty much now that they've reduced the extra space, it just seems like a really attractive building. Like if you look at that first picture, following my computerized brief on page 10, I mean, compare that building to the buildings around it. So if the buildings around it are C space, does this look like the buildings around it, or does this look different than the buildings around it? Does it look superior or does it look inferior? So I'm confident that to me it looks like a B.
Okay, thank you, Mr. Brokus. No further questions.
Thank you. Mr. Mahone?
Just a couple following up with respect to the cap rate of 6.75. The 20th and 80th percentile shows no variance, whereas the other exemplars, Colliers, CBRE, Cushman and Wakefield all have a range. Is there an explanation as to why there is no range, either in the downtown A or the downtown B in the city of Winnipeg cap rate characterizations or calculations?
That's a good question. I'm not sure. We are at 6.75. So when you're going across, Colliers has a range of 6.25 and 7.25. CBRE 6.5 to 7. So we're in the middle of both of those ranges. Cushman and Wakefield 6.25 to 6.75. So for that one, we're at the high end. So I'm not sure why there's no variation, but that number seems to be fitting into the middle of the conclusions of the other researchers. So I feel reasonably confident that 6.75 based on that additionally is the correct cap rate for this property.
Okay, thank you. The other question I have is with respect to the characterization of A or B. And as you pointed out earlier, we've seen this chart many times. I don't think I've ever seen an addition to the chart that has the C level categories. Is that something that's tracked, or cap rates for C buildings or C category buildings tracked? I've never seen it.
You know what? I don't know. I usually just do apartments, but I agree. I haven't seen it either. So I can't answer that question. Sorry.
Okay. Okay, fair enough. And just finally, with respect to the B versus other characterizations, you focused, it seemed to me at least, primarily on the location and the area in which the office building was situated. The things like the floor plan, the office suite size, or access to amenities come into play in the characterization of a building as B, A, or C? Or is that something you can answer?
You know what? I wasn't the one who put this on. I just by looking at the property, it looks like a newer office building. It had some exterior work done to it. The top floors are renovated into apartments. It's well situated, and if we're being told that the properties around it are C and D, just go to page 10 and ask yourself, does this look like the properties around it at all, or does it look like properties that might be more attractive? So I feel that as an OFB, it looks like an OFB to me.
Okay, thank you. I have nothing further.
Thank you. Gentlemen, the floor is yours. I just want to mention that you are in agreement with the apartment space value, and for the office space, there's the city are 1.6 higher than your presentation. So you may, the floor is yours. So take us through your presentation.
Okay, we are looking at 433 Main Street Limited. And again, this building is assessed currently at $4,325,000. That is the commercial portion that we are looking at right now. And you can see that there are 15 stories. In terms of the intended use report, it is obviously for the purposes of this appeal, and that is the intended user also. On page 4, you can see a description of the property on the corner of Bannatyne and Main Street. That is the southeast corner. Again, this building was built in 1976. It's being used as a mixed-use building. That is one thing that you have to keep in mind, that this is no longer an office building. This is, I believe Mr. Brokus had classified it as a res am. So that is a residential apartment with commercial element to it. So its previous incarnation as a Class B office building is not what's there now. Now, in terms of the highest and best use, we continue to believe that it is currently it is still the current use. And in terms of the analysis, we're looking at the 2022 taxation year with a reference year of April 1, 2018. On page 6, you can see that the burden of proof is on the assessor. And I will skip over the multi-residential portion and we can continue to page 8. So we've classified this as a Class C office building or Class C space. As the assessor also indicated, this space had not been renovated, whereas the space above, which is the residential portion, has been renovated. Again, we've addressed the valuation of that. In terms of how we came to this conclusion, well, we referenced the office building rating system. Now you can see the entirety of the office building rating system on page 30, starting on page 38 of the brief. And it is, if you turn to page 38, you can see the office building classification study, Winnipeg, Manitoba, March 1st, 2000, for the City of Winnipeg Assessment Department. Now, the way they classified their systems or their buildings is based on a point scale, where A class received more than 25 points on this scale, B between 20 and 24 points on this scale, C between 15 and 19 on the scale, and D between 10 and 14 on the scale. Now we went over this scale because the building changed since it was originally built. And we revised the point rating on it according to what we see there now. And based on this new calculation, this one scores an 18. So based on that, this falls into the C category. We also see that it also is predominantly in an area of Class C and Ds. Regardless of what it was or its previous incarnation, it's not that anymore. We know that the space hasn't been reconfigured. It's still as is for the most part. We feel that the space is more reflective of a C-class building. Now, that being said, we know that most C-class buildings and even D-class buildings in this area have been updated. So wherever you see a building age for one of those properties in this area, whether it was built in 1912 or 1925, the effective age is not reflective of those years built, meaning that those buildings have been, for the most part, updated. The finishes in those buildings have been updated. And also we can comment on, in general, that many of the leases in this area belong to government. And there are specified requirements for government leases in this area. So I don't think the argument of, there being difference in terms of the finishes really holds up. I think the space in this area tends to be fairly consistent. So again, based on our reclassification calculation of the point rating system, this falls into a C, and it makes sense because really this is not competing with B-class buildings anymore from our perspective. On page 9, you can look at the market rent that we've used. For the most part, we went with the rents that were in place, and we updated some rents. So you'll see some consistencies there at $10.25 per square foot. And those are consistent with the asking rents that are in place. So on page 9, about halfway through, you can see a chart there that says $10.25 per square foot. That is the asking rent. Now, I'll ask you to briefly turn to page 28 of the brief. Sorry, I'm going to revise that. Page 23. And you can see that this is where we drag this information out of. Okay, so if you turn to page 23, You can see the chart there that says 10.25 per square foot. And cabin taxes of $15.98. Now, while the assessor was presenting his information and I asked questions, I asked him exactly what the gross rent was essentially. And I said, and he agreed with my comment on it being a combination of the net rent plus cab and taxes. Now you can see there that there is a 10.25 rent there, $15.98 for cab and taxes. Now, if we add that together, it actually comes out to 26.23 gross. So 10.25 is what they were asking for net. And that actually is supported by the evidence that the assessor also gave at $25 gross per square foot. In terms of vacancy allowance, the assessor has applied a vacancy allowance of 9% with the subject. The subject's 3-year stabilized vacancy was nearly 25%. It was known as of April 2018 that the vacancy by the end of 2018 would be 34%. And on page 10, you can see the revised vacancy. So we have a chart here looking at vacancy for this location starting in 2010, going up to 2017, and then the expected vacancy in 2018. Now, for the most part, this building was chronically vacant for that time. So we applied a vacancy of 15%. In terms of the shortfall, the City of Winnipeg Taxation Department applied a shortfall of $11 per square foot. The actual recoverable expenses in 2017 are approximately $16 per square foot. And we used $15.98 per square foot in our calculation as per the 2018 estimate provided in the property's marketing materials. Non-recovered expenses. Well, we know this, and we can go further into depth after I present on this property and go over the non-recoverable expense study. To summarize it, basically the City of Winnipeg took away that 7% that it had traditionally used for the 20 years previous. We don't have any information to suggest how they came about to that decision. So we'll leave it at 7% for now. I'll present on the non-recoverable afterwards. In terms of the cap rate, on page 11, you can see that the most relevant fact here is that the cap rate information that we derive is derived from comparable sales. On page 12, down at the bottom, you can see the change in terms of brokerage firm capitalization rates for downtown A and downtown B. Now to go back to a point that one of the panel members made, for the most part, no, we don't see documentation on cap rates for office C and D. So what we're looking at strictly here is the downtown A and downtown B. I'll ignore the suburban because we're not really dealing with a suburban building here. But in 2016, Collier's rate went from $550 to $625 in Q1 2016 to $550 and $625 in Q1 18. CBRE $550 to $6 in Q1 2016 to $550 to $6 in Q1 2018. Now we don't have the background for the Cushman, so I'll leave that one out. But basically what that's suggesting is that there's been no compression in the capitalization rates. And that goes for downtown B, where you can see 6.25 to 7.25 for Collier's, 650 to 7% for CBRE, and that's in Q1 2016, In Q1 2018, there's virtually no change. So we can see that there's been basically zero compression. In terms of the city capitalization rates, you can see that, again, this is supported in the rates that have been shown by the city of Winnipeg as well. There's been almost no compression from 16 to 18 for A and B classes. For C class, they have shown some compression, and that's an upward movement. Sorry, a downward movement from 7.5 to 8% in 2016 to 7.05. So basically, what they're saying is that the risk for downtown A and B pretty much stayed the same from 2016 to 2018. But for downtown C class, the risk actually decreased. And then that is the same for downtown D. What they're saying is that the risk actually decreased from 16 to 18. Now you can see the Altus applied cap rates for 2016 there. However, I will ask you to go to the 2021 and 20. This also includes 22. On page 15, you can see our ranges for downtown A is 625 to 650. Office downtown B is 675, and office downtown C is 750 to 8%, and D is 850. Now you can see on page 14, you can see the properties that we actually derived capitalization rates for. Now that is simply a summary of the capitalization rates that we looked at where sales occurred. However, the chart and our conclusions are actually on page 15. Now you can see also that we have a summarized conclusions on the cap rates on page 15. So I'll briefly go over those. The class A is 6%, is considered too optimistic considering the supply demand in this sector as of the reference date. With the cost of money increasing, supply increasing, and demand steady, there is no reason to believe the cap rate for this sector would not increase between April 2016 and April 2018. As of January 18, True North had its first tenant, TDS, moved in. Others are to follow, including MNP and Scotiabank. These tenants are vacating current Class A space at Portage and Main, adding to increasing vacancy and decreasing net effective rents. A premium should be applied to Class A office of 0.25 and higher if the site-specific situation indicates a reduced NOI in the very near future. Now for Class B, the cap rate applied to Class B of 6.775 appears fair. And for Class C, the cap rate for Class C should not have it compressed by 40 to 95 points, especially with the current flight to quality by tenants. And that is an important point to make, that with these better grade spaces opening up at True North, there is essentially a game of musical chairs playing around in the downtown. So different tenants are moving from one space to another. And again, we are recognizing that there is a change in the market in the C class. So a cap rate of between 750 and 8% should be applied for the same as the last cycle. On page 16, you have the entire summary. So we have a 1976 portion. We've classified it as OFC, 31,055 square feet, with an income of 345,642, vacancy of 15%, an effective market rent of 293,796, 7%, and that is those non-recoverable expenses that we've included in this. And we have an NOI of 198,791, to which we've applied a 7.25 capitalization rate for an income of 2,741,949, or $2,742,000. Now, continuing into the appendix, we can see on page 22, the points that I highlighted regarding the asking rents. This is a 2017. I don't know what you would call it, a brochure advertisement. So just before the reference date. And again, you can see that the asking rents are $10.25 negotiable. Common taxes additional at $15.98. I believe I said that it had come to about $26 gross, which again is supported by the assessor's information that he had provided in his brief. The rest of that is just advertising materials, materials regarding the apartment, and some pictures of the office spaces. And with that said, I am open for questions.
Thank you, sir. Mr. Barocas, questions of Mr. Navarro?
Yes, thank you. So we could go to page 10. You included a vacancy table. Is it correct that the vacancy reflected here, the vacancy rates, are what was there before the floors 5 to 14 got renovated into apartments?
Well, again, we're looking at the economic conditions as of April 1, 2018, not to be confused with the physical condition of the building as of 2022. So we're kind of mixing things up there when you say that.
Okay, so just to be clear, so they had a 9 floors of more floors of office to rent out when they calculated their vacancy here over a year basis. Like, it's not physically the same asset though. So would it be fair to say that this table might be a little bit misleading without knowing that information?
Well, you can also see that on some of the spaces we've applied a rent of $10.25, $10.25, $10.25, $10.25. And that is the asking rent that we've applied there, as opposed to some of the other rents that you see on there, which are $15.02, $17, $11.90, which I suspect, as you may have looked in the income and expenses questionnaires, are the actual lease rents that are in place.
Okay. And then on page 8, you've got a table here that says it assigns points to various categories for the purpose of coming up with OFB, OFA. Is that correct? Is that how you made that determination?
Well, so you're talking about the scale there?
Yeah, office building rating system.
Okay, so that is based on page 38. If you look at the end, the appendix on page 38, you can see the office category classification study that we included in there from March 2000 for the City of Winnipeg Assessment Department. That's where this study comes from on how the office building rating system and office classifications were determined.
Okay, and just under the building age row, got 1 point saying it's 40 plus years. Did you take into the account the renovations of the building overall when you assigned a 1 there? Or was that something that you didn't do?
Well, why don't we turn to the study first before? Okay. So there are categories here where 40 plus equals 1, 30 to 39 equals 2. We took it as the age that is in there. I believe the effective age that you have on there is 1976.
Okay,
However, if we were to bump it to the next one, which gives it 2 points, then we would still be looking at 19, which would still keep it in the C category.
okay. And has Altus ever classified this property as a B before?
Absolutely, Mr. Rokas, when it was an entire office building.
All right. Those are my questions. Thank you.
Thank you. Ms. Nesbitt,
I have no additional questions, thank you.
I thank you. Mr. Mahone?
Yes, I do have some questions with respect to the numbers that you have calculated, and if you can help me out here, please, Mr. Navarro, on page 16, looking at the chart, the first question I have with respect to that chart is the cap rate. You spent some time talking about the class, and we spent some time on questions as well with respect to the cap rate for Class C buildings, 7.5 being your starting point. But here you've assigned a cap rate of 7.25. Why the difference?
Well, I believe that also has to do with part of the renovation issue. And overall the investment risk. So we don't believe that it maybe sits completely in that 7.5 to 8.0 scale. We gave it an additional premium of 25%. I believe that's about it. Jared?
Okay, fair enough. Ed was a little confused about that. The other question I have is a comparison between the numbers and on page 16 from your chart and the summary on page 17 with respect to your requested assessment. Your requested assessment from the chart on page 16 would appear to be $2,741,949 or 2,742 for rounding purposes, but the requested assessment is 2,651.
Yeah,
really the 100,000 difference. But what is the?
Sorry, I would say that 17 is just a typo. It is 2,742,000 rounded.
Okay.
That is how we calculated it on the chart. So that's the value that we would go with.
Okay. The final question I have with respect to the calculation of cap rates, and you've included, and I'm looking now on page 14. Just wait till you get to 14. You've got below the double line, there's three buildings, probably not residences, buildings in the downtown area: 200 Portage, 259 Portage, and 423 Main Street. Those market cap rates were calculated, and there's a description of each building. Is that
correct?
Okay. Would I be correct in assuming that 259 Portage and 423 Main Street with the heritage status would have a calculation of cap rates that would be affected by their heritage status? Their cap rates would be higher, or would be, yes, higher percentage wise than one that's not a heritage status?
I think that's a fair conclusion.
Okay. And the calculation of, the characterization of 200 Portage Avenue as a B class was the same chart that appears at page 38, and the reproduction of it on page 8 used to determine the classification of that building?
In terms of the classification system,
Yeah.
No, I believe that these are classified, these are well-known Class Bs, Class Cs. I don't think we necessarily put those classifications in there.
Okay. Thank you. That's all I had. Thank you.
Thank you, Mr. Mahone. Mr. Navarro, Mr. Mahone raised that question in regards to page 17. I was completely baffled. Like it doesn't make a
I apologize for that. However, the chart is where we are actually making the calculations,
yeah,
so
so,
that's what I would do.
I spent a few hours ahead of time, you know,
Yeah.
and anyways, in essence, I guess to summarize, I guess the NOI, you have a difference. The city's at $100,000 more than you are, and you know, and the cap rate. So I think that about concludes anything. Do you wish to summarize it all, or?
I'm
Well,
okay, thank you.
Yeah, I mean, we can summarize that this is an office building, or sorry, let's call it a res M, because it's not an office building anymore. And I think that's what has to be kept in mind, is that what it was previously is not what it is now. It's not going to attract the same type of tenants. There are sure some long-term leases in there. I will note that the passport office has been in there for quite a long time. However, there has been space vacated there. And I believe that that is the future of this property, is that it's not going to be able to attract the same quality tenants that it did when it was that premier location in the 1970s and 80s and 90s. It's not that location anymore. So that's why we've classified it as a C, and we'll hold to that.
I thank you. We're just a little out of order. Mr. Barocas, do you wish to summarize it all?
I'm okay, thank you.
All right. I think now we'll go to 433 Main Street for the 2023. So, Mr. Barocas, whenever you're ready, you can take us through this property, and we'll have a V-Day of 2021. Is that correct?
Yeah, reference date April 1st, 2021.
Yeah, all right. The floor is yours, sir.
Thank you. File number 23-52, roll number 13060750100, 433 Main Street, same property as before. So you can see first page, again, we're dealing with two income streams. Commercial income, commercial assessed value is a bit higher. The residential jumped quite a bit. I did some research on the property. Physically, nothing's changed from the last file we just talked about. But I made a reduction to the property on the CC20 classification of $17,932,000. Page 5 are the calculations. So if you go there, you can see what I did. I basically reduced the potential gross rents. The applicant and I, again, we're talking about this ahead of time, and boosted the cap rate up to 5. And so that generates a recommendation of the $17,932,000 rounded for the CC20. I don't think that's going to be in dispute. So I will, again, not focus my presentation. Keep it brief because we talked a bunch on this already. So page 2, request for income information. No problems getting any of the income information. We got the subject sale history. So this, again, this reflects prior to the renovation of the 5th through 14th floor. So that sale doesn't physically describe the sale price isn't for the physical asset we're valuing for this file. Income value summary here. This is the former valuation. My recommendation and real workup for the recommendation is on page 5. So blow through that to the subject property market income. So the model bumped the rents a little bit. We're in the $12 to $13 range predominantly, other than the smaller premise for 34 square feet is at $15.24. Page 5 is the recommendation. Rent comparables on following page. And then some comparable leases as well in the area, and they range from $12 to $16 in the general area. Page after that is some multifamily cap rate evidence. You've seen this chart many times over. My recommendation is at 5% cap for an overall value of $17 million. 932. I don't see much dispute in that. But these are just examples of sales that happened in the market. I calculated the cap based on the 3-year stabilized expenses and the sale price, and I was able to determine cap rates for these properties. Then we have our overall chart on page 9. And then there's the same pictures that were in the last brief. So sum up, I made a recommendation on the CC20, and then the commercial bumped up a little bit based on the model increasing the rents a little bit, and other modeled parameters. The cap rate remained the same at 675 for that income stream. That's my evidence. Thank you.
Thank you. Gentlemen, there was a recommendation of by the city of $17,932,000. Are you in agreement?
Yes, sir. We accept the quantum on the CC20.
Panel members, any questions in regards to the rec?
No questions for me.
I don't have any questions, thank you.
Okay. Mr. Barakis, your presentation in regards to the office space, the value of $4,546,000, you're standing with that?
Yeah, no change on that one.
Mr. Story, Mr. Navarro, questions of the assessor?
Yes, Mr. Barakis. In terms of page 7, your comparable leases, did you get a chance to inspect any of those?
No, I did not.
Okay. Can you tell me which ones are attached to the walkway system?
I don't have that information.
Would 220 Portage feet, for example, be attached to the walkway system?
It might be, but I don't have that information in my brief.
Okay. In terms of your capitalization rate evidence, now I'll note that peculiarity with the chart that's on page 9, and in the previous cycle there was a column there that said the high and low as well, where you put in a high and low for the capitalization rates. Can you comment on why that was taken away and all we have now is your 20th and 80th percentile?
Let me pull it back. I don't know. That's a good question. I've actually never really noticed that before, but I'm not sure.
Okay, and in terms of the questions that I asked regarding the classification of this property, I'll ask the chair if he can just carry over the commentary that we made in the previous appeal for 2022, as they are essentially the same questions that I would have asked.
Okay, thank you.
Okay. And I am good on that. Or do you have any additional? We're good.
Yeah.
Miss Nesbit, any questions of the assessor?
I have no questions, thank you.
Thank you. Mr. Mahone?
No, and I have no questions. Thank you.
Gentlemen, the floor is yours. In regards to the office building.
Okay. So I've described the property and some of these aspects of our brief in the previous appeal. So I will skip that and we can actually move straight into the income approach starting on page 10. So again, we've classified this as a C, where the city of Winnipeg has classified this as a B class. The city applied a rental rate of $12.73 per square foot to 31,733 square feet of leasable space. The tenants in place had gross leases. Cushman Wakefield in their market beat report for downtown Winnipeg Q1 2018. Landlords in the CBD will need to be aggressive as tenants pursue opportunities for superior quality space or more attractive leasing terms. And this gets back to the commentary that we were making on, for example, True North Center opening up and there being a flight to quality. And basically what that creates is a kind of musical chairs for office space in the downtown. So I'll ask you to flip to the next page where we have a set of comparables, 36 comparables with an average of 951 and a median of 1008. So indices 1 through 11 are comparable character office building located in the East Exchange, originally built in 1929. The rents are, as most of the comparisons are collected gross and netted down to estimate net. The gross rents in this comparison are between 18 and 22.95 per square foot. So we noted before that ours was at $25 per square foot. Or 26.23, sorry. Indices 12 through 17 is the Grain Exchange building originally constructed in 1906 and connected to the underground walkways and adjacent parkade. Now, what we'll note about the Grain Exchange building is that it is a historic building. However, it has been completely renovated. So there was a huge redevelopment of this property. So while it still remains a heritage building, the office space inside is very good quality. So Index 18 is located on Main Street just south of Portage and is a two-story character office originally built in 1912, occupied by a college. The rent includes nearby parking stalls. Indices 19 through 26 are very similar but superior, but a superior property just near Portage and Maine. While the office tower built in 1912 is nearly very similar to the subject, it has the advantage of being connected to the walkway and to a parkade at 35 Albert through that. And indices 27 through 36 are 3 different character offices in the East Exchange. Each has close access to surface parking. What we'll note about our subject is that it really doesn't have parking. So that is also a major disadvantage of this property. It is, one of the few, in its previous incarnation as an office building, one of the few that doesn't actually have access to parking. So we can look at, for example, B-class office buildings in the downtown on Graham Street, St. Mary, and for the most part, they all have access to some parking, either adjacent parkades or surface parking. This one is out of place and not having that access to surface parking. And surface parking in the East Exchange comes at a price. There aren't many available surface parking lots, and they tend to be connected to one of the buildings themselves. So what that means is that the office building controls a certain amount of parking for its tenants. In this case, this building doesn't have any of that. So on page 12, you see our chart there and the rents that we've applied to them. For the most part, we've adjusted all of these rents. You can see that most of them are no longer at 1025. The reason for that is that most of these leases were coming up for renewal just shortly after the reference date. So while we start with actual rents, because we believe that actual rents can be market, we start with actual, and if we need to adjust, we do adjust. And in this case, we decided to adjust simply because most of the leases were coming up for renewal around shortly after the reference date. So we have a rent of 1182, whereas I believe in the previous cycle we had about 1113 per square foot. The vacancy allowance that we've applied at this time around is 12%. And that is because we've applied the premium for the office C. Now, this, I believe, is the standard office allowance that is applied to office Cs in the City of Winnipeg's reports. In terms of shortfall, $12 per square foot, non-recovered expenses, 7%. We haven't deviated from that. And just to quickly summarize the issue of non-recovered expenses, again, what we need to stress here is that these are not the management expenses that are typically present in the expense questionnaires where you will note them. So these are essentially non-recoverable expenses. For the most part, I think many of you have already seen the non-recoverable expense study quite a few times. So non-recoverable expenses can include leasing commissions, tenant improvements, free rent, marketing, advertising, bank charges, mortgage interest, bad debt, professional fees, owner building maintenance, asset management fees, yada, yada, yada. For the most part, what we include as non-recoverable expenses are 4 types, and those would be leasing commissions, professional fees, asset management fees, and advertising and marketing. Generally present in most multi-tenanted properties. So whether it's retail, office, those types of expenses are very typical for those properties types if they are multi-tenanted, and in this situation it is multi-tenanted. In terms of the capitalization rate, we've applied a capitalization rate of 7% in our evaluation, and that is consistent with our capitalization rate study. I'll briefly skim over that after I finish with this. So on page 14, you can see our chart. 31,880 is the rent, or sorry, the leasable area. The rent is 376,880. The vacancy is 12%. Non-recoverable expenses of 7%. And we have an NOI of 247,306. With a capitalized at 7%, that gives us a value of 3,532,936, or 3,533,000. And on page 15, you can see that we got it right this time. So the remainder of the presentation is the appendix. So there are some materials there that are specific to the apartment. On page 27, you can see the start of the brokerage materials there. And you can see again the 25 per square foot gross rent, and that is also, again, that is a mixture of the net rent and the CAM and taxes. So what you're looking at there is the gross $25 per square foot. You can see the building classification study that we included in our previous brief, and also some pictures of the location. So that being said, I am open for questions.
Thank you. Barasik? Questions?
Just my questions from last file be carried forward to this one. Thank you.
Thank you. Ms. Nisbet,
I have no questions, thank you.
thank you. Mr. Mahone?
No, I don't have any additional questions. Thank you.
Okay. I guess in regards to the summary, the city of Winnipeg has got $60,000 NOI, higher than the applicant. And value wise, we're talking about $1 million difference.
Yeah, I think we've closed that gap.
Okay.
I think as I said before, we noted that many of the leases were coming up for renewal just shortly after the reference date, so we felt that we had to adjust the rents upward, and we did that. But it is in keeping with the comparables that we also listed. So again, I think I mean, obviously our position is that the model is high.
We'll get back. Mr. Barosik, do you wish to summarize?
No, thank you.
Mr. Navarro, you talked about possibly doing a recap in regards to cap rate, or
Yes, let's do it.
and then you can summarize.
Okay. So I briefly skimmed over this previously, so I won't necessarily go into the materials that are there regarding, for example, the Manitoba Court of Appeal case on page 3 of our brief. There is the capitalization rates that are derived from comparable sales. We're not using the yield capitalization technique or any other technique to derive our cap rates. On page 5 of our cap study, you can see the relative changes from 2016 to 2018. We kept that in place just so it could give you some background on it. So again, just to summarize what happened between 16 and 18 is that there was basically no compression in the cap rates. In terms of the sales, you can see the sales that we've looked at. Not necessarily what we used as judgment to come up with our cap rates, but we've used them simply to note some of the sales that have occurred in the downtown. And those are the pre-pandemic ones on page 6. You can see the Altus Group capitalization rates on April 2018. Again, this is coming from the previous cycle. And then on page 8, we start with the pandemic. So basically we all lived through this. We all know what happened during the pandemic. Everybody started to work from home. And for the most part, a lot of that is still there. There are people who have come back to the office. I mean, I can comment. I can say that I've come back to the office, but you know, on any given day, our office is quite empty, and that can be probably said across the board throughout the downtown. So I think what a lot of property owners, people in the industry were saying at that time is that it's simply creating a high degree of uncertainty as to what's going to be happening with the market in general. Is there going to be a requirement for less space? Well, let's see what's happened with our particular property. It was formerly an office building, correct? And it wasn't really useful enough as an office building. It didn't have that functionality. It was somewhat obsolete. And given the climate, it's now mostly an apartment building. Will this happen to other office buildings? I suspect probably yes. I've had the opportunity to inspect quite a few office B classes and C classes this cycle. And the one consistent trend that I saw walking through these buildings is that nobody was there. And that says something. So Altus Group in November 2020 undertook a survey of people that we deal with in the industry, and some of the conclusions that were drawn from this study are available on here. You can see starting on page 10, some of the questions that were asked in the survey. On page 10, you can see, do you expect office tenants to downsize their space requirements in the future as a result of the increase brought about by this pandemic? 57% said yes. A portion said no, 22%, and there was a significant portion also that said they don't know. In terms of the number of responses, you can see that in the chart. On the next page, what percentage change in market face rents are you forecasting for the 2021 fiscal year? Well, in terms of the top quality office buildings, you can see that most are saying no change in rents, meaning that they're not going to go up. They're suspecting that they're not going to go down. But next over to that, you can see a significantly higher portion is actually saying no, they're actually going to decrease. And that is actually the trend that we're seeing. So you can see that a larger percentage of the people are actually saying that there's going to be at least a 5% decrease in the rents. In terms of the lower quality office space, same question, probably just between 20 and 10% of the respondents are saying no change. But a larger percentage are saying 5% decrease, and that's closer to 20%. An even larger portion are saying a decrease of between 5 and 10%. That is more than 30% of the respondents. And slightly less than 30% of the respondents are saying that the decrease is going to be larger than 10%. So this tells you that, again, these people are bracing for changes, systemic changes to the office climate in the downtown. Now, next question starts on page 11. Overall, the majority of the respondents were of the opinion that office capitalization rates would increase in 2021. The percentage of those expecting an increase was actually greater in November 2020 at 40% versus June 2020 at 27%. The majority felt high quality office cap rates would increase 25 to 50 points. For low quality, the majority of respondents expected 50 to 75 basis point increase. So higher quality cap rate trend expectations for 2021. And again, you can see the difference there between November and June. So, I think it's fairly evident. I think most people can, just from the amount of appeals that you've heard on office properties, you know that something happened during this time. And it wasn't just a blur. It could possibly be something that is going forward and will change the office market in the downtown. And that's partly, I think, why we're seeing the first of a few redevelopments of office properties in the downtown, because there's certainly less of a market there for downtown office space. And you can see that there's also a plenitude of apartment construction in the downtown. Some would say that there's probably an oversupply of apartment space in the downtown, but they keep building it, so they have to do something with it. So if it's not viable as office space, it has to be redeveloped into something. It's not going to sit there vacant. So you can see our Q1 office capitalization rates noted by brokerage firms on page 15. And the change from Q1 18 to Q1 21. For office A goes from 550 to 625 for Colliers. In Q1 21, it's 550 to 625, so it remains unchanged. And if again for CBRE, it's 550 to 6 in Q1 18 and 550 to 6 in 21. No change. And then again, we see Cushman, we have Cushman now, 550 to 625 in 18, 550 to 625 in 21. That is absolutely no change. So no compression, nothing. So the brokerage firms are saying that for the best quality assets, there's no change in the risk profile. That's, I think, is significant. Now, if you're looking at the downtown B, again, we're going from 625 to 725 in 18 for Colliers and 6 to 725 in Q1 21. CBRE 650 to 7 in 18, 650 to 750 in 21, and Cushman 625 to 675 in 18 to 650 to 7 in 21. That's a 25 to 50 basis point change. I'm not going to go over the suburban A and B because we're not dealing with suburban A's and B's. We see some of these sales that we looked at. So Dover Court, I believe Dover Court is a suburban. 433 Main Street is our subject, and 870 Portage. So those are the sales that we looked at. Simply said, that's not how we developed our capitalization rate for this. However, our cap rates are noted on page 17 in the chart there. You can see Class A's are at 625. In 2018, you would have to flip from the previous chart on the 2022 appeal, but I have it for you. In 2018, we had between 625 and 650 for the A's. So 625, you know, a bit of a change. We had a range before in the previous cycle. For 7, it was 675 in 2018. It's now 7 in 2023. Sorry, I'm dealing with a reference year on one and tax year on the other. For the 2022 that we heard recently, we had 675 for the Class B. For the 2023 that we're dealing with now, it's 7. So we've increased the capitalization rates on Bs to 7. That's a 25-point change. That actually coincides with what the brokerage firms are saying. 750 to 8% in 2022. In 2023, we are looking at 775 for Class C's, and Class D, 850 is what we had in 2022. In 2023, it's 850 again. The city, for example, in 2022 had 6 for Class A and 6 in 2023, 6.75 in 2020, and now they only have the percentiles for 2023. So we can't really get too much from that. Again, again, what we stressed in our questions is that they've changed their methodology for posting their cap rates. So they're not putting in a high and low anymore. They're just putting in their percentiles. So 7.05 in 2022 for Class C, and that has changed with an 20th percentile 760 and an 80th percentile 690. So basically what we've done is we've added about a 25-point increase on the B's and C's. And I think that's probably reflective of what's happening in the marketplace. We can see that For the most part, I don't think there's much of a change in the city's understanding and capitalization rate for Class Cs. But really, when we talk about that movement to quality and the added issues with the pandemic, I don't see how you couldn't have, not increase the cap rate, and we've done that. We've applied 25 extra points to it. So that is a basic summary of the capitalization rates. In addition to that, we also have our calculations on how we derived our capitalization rates for the properties that we looked at. You can see the valuation charts there on page 20, 21, and 2022 and 22. And then we also have some brokerage firm information added to that. So that's a basic skim of the capitalization rates. So if you have any questions, I'm open to that.
I think you wish to summarize in regards to what for the last property that we heard, or was that it?
Yeah, I think we've discussed everything. I don't think we need to summarize at this point.
All right, Mr. Lund. We'll call the meeting back to order, and we're going to go to 104 Princess Street. And we're gonna do the 2021 year. Mr. Baracus, whenever you're ready, you can take us through this property.
All right, thank you. File 22-4831, roll number 13060980100, 104 Princess Street. It's again a Res M we're looking at here in the Exchange District. We've got commercial and we've got multifamily. It's 5 stories. There's 2 buildings. The actual year built we have range from 1985 to 1950, and we've got an effective year built of 1996. We've got 39 suites, no parking on site. So just a little physical background on the property. The property, basically, it was 2 older buildings that were conjoined on one pad. Then part of it was demolished, and there was a gap between what remained of the former property and the adjacent property, and in between they constructed an apartment building, and then they also did some renovations, putting a 2-story addition on what was the existing remaining building. So quite a lot going on there. You'll see it's more evident if you go to my brief, and you can see the pictures. I guess that would be on page 13. And it's just like an artist rendering, but that's basically what they did. You can see the new apartment building in between the older building and the older building that remained. So loft style, some sort of loft style apartments. You can see if you continue on from page 13 downward, not inconsistent with other loft style apartments in the Exchange. And then there's also, they have a little rooftop patio as well. So just circling back to my first page, I made a recommendation. I bumped the cap rate to 5.25 on this property, which takes it down ever so slightly to $5,032,000, and that was based on the $264,001 80 net operating income. And that's just the modeled income. The average monthly rent was overridden based on the actuals and factored back. And then we just used a modeled expense ratio of 46-43 for the property. Then I boosted the cap to come out to the 5,032,000 on it. So we're confident with the that line of the valuation. There's a little bit of commercial that still remains in the property. So if you go to my page, we'll go back to page, let's see, page 2, that's where we are. You can see the requests from income information have been good. There's no subject sale history that's relevant to the current physical asset, so we're not putting any weight on that or didn't do any research on that. The income value summary on page 3 shows that there's 8 bachelor, 21 one-bedroom, and 10 two-bedroom. Average monthly rent $1086.33. Page 4 just shows the overall number of suites and rent per suite, and then it also shows the commercial that we have there, which is we got 2 units. We got an OFB standard quality, and we've got retail as well. 4,500 square feet at $13.37, and retail at 1,142 square feet at $16.77. As per the model, and then we have a rent comparables on page 5. So first thing you know is comparable number 1, 320 Austin Street. You can strike that off. I don't know why that populated in the field like that. That's a Manitoba housing property. It's not relevant to this property. So that's no basis to support the rent. However, comparables 2, 3, and 4 are good. The properties of a similar interior suite quality in same area. 92 Princess is very close, as is 165 McDermott, and they support rents in the high $1,100-$1,200 range. And again, we saw the actual rent roll, we were able to factor it back. So pretty confident in the rents that we have. I don't think we're too far off from the applicant either. So I won't dwell on that very long. Here are some comparable leases on page 6. Just pulled from the general area. They are in the $10 to $15 range. So right around what the model is assigning. The commercial spaces in the subject property. We've got a commercial and residential cap rate table on page 7 and a municipal act excerpts on page 8. On page 9, there's just the permit. I included some permits just so the panel could have kind of a written record of the physical changes that were done to this property. So there was a 1080 meter square addition to the existing commercial building. So there's structural work done to the existing building. New opening between 110 and 114. Replacing columns, 2 new floors added to the 3-story building and new roof framing. So there's an addition, and then there's 2 new floors added. When you're looking at the total project value of 100 million, or rather 100,000, doesn't seem to match up with the physical reality of the undertaking. So I wouldn't put any weight on that. Still, it's there. Didn't remove it. And then there's just some fit up permits, 450,000. Fitting up the main and basement levels for one of the commercial tenants, mechanical, electrical, and minor structural work. On page 11, it says they placed some windows, brick repointing, reopening of previously bricked boarded up windows. So they've been doing some work on this property. We got a cost report as well for the overall cost from the owner, and it's at $34 million. So that's why the permit is coming in a little bit shy. I'd say at $100,000. Still, it's not done on a cost basis; it's done on an income basis. So I don't put any weight on that number. That's how it would sell for. And then we're back to on page 13, basically the rendering of the picture of the outside. Then some pictures of the inside. You can see the interior of the suites are good, and the mailer at the end, it predates the physical asset that we're actually valuing. So it doesn't have any relevance. I just threw it in there. I could have not thrown it in there just as easily. So based on my recommendation, bumping the cap to 5.25, we get a residential valuation of $5,032,000. The comp support, the rent that we're using, and the expense ratio is modeled. The office and retail commercial valuations are also modeled as well. That's my evidence. Thank you.
Thank you. Mr. Story, questions of the assessor?
Yes, sir. I have a few questions. Mr. Barocas, have you visited this property?
I have not. A member of our department has, though, I believe.
Okay, and just to be very clear, on your first page, I think you had mentioned the actual years were 1985 and 1950, but it is indeed 1885.
Right, 1885. Yeah, I misspoke.
Okay, and you said that
It's been a while since we've presented, so I'm kind of
right. Yeah, no, that's fine. And you'd mentioned that there had been some goings on there, but just so we're all on the same page, these two buildings that were connected by a party wall were built at the same time. There was a chemical fire in 1950, and that second building was built at that time. Is that your understanding?
I believe so.
Okay. And that effective year of 1996, that would be, I suppose, applied at the discretion of the attending member of the assessment department. Is that a fair comment?
Right, to try and reflect the magnitude of the renovations that they undertook.
Right, okay. And we can agree there is no parking associated with the apartment stream. So can we agree that that would typically be considered a negative factor in terms of called the risk factor of the asset going forward? Is that a fair comment in your mind?
It would definitely be a line that would be missing on an income stream basis.
Right.
I mean, it would be more of a negative. Like, don't get me wrong, it'd be better if it had some parking, but it would be more detrimental if it was like in the suburbs rather than like downtown.
Correct. And in terms of the location, so we're on the West Exchange, the zoning is character. And are you aware this property carries on title a grade 3 heritage designation?
I do not have that in my evidence, so I can't speak to it.
Okay, but and just so I'm clear, this is sort of a hybrid valuation where part of the inputs are model generated and then some are overridden by the assessor. Is that correct?
In regards to the apartment, the rent was overridden. Yes, the rest of other than the cap rate increase based on my discretionary bump there, the expense ratio, the vacancy, those are modeled. So it is hybrid. That would be fair to say.
Okay, so in terms of the model's capacity to recognize, let's say, nuances on a site-specific basis, does the model have the capacity to recognize a heritage designation, for example?
I don't see an input. I haven't seen an input like that in our model, so I don't believe so.
Okay, and would you agree with me that a property that carries a heritage designation carries with it a requirement, as a caveat on title, that all permitted work be done through a separate, let's call it channel of the city of Winnipeg's property planning and development, and all of the work on heritage buildings have to satisfy certain conditions, whether it be the character of the area, the character of the building, and have to go through a different channel. And then I guess my follow-up to that is that would typically make renovations or alterations more expensive and more timely. Is that your understanding?
I know from my experience that they do have to clear what they're going to do with additional levels of approval based on how much of it has a heritage designation they have. Looking at this property, it looked like they've done quite a bit as it currently stands, as we're valuing it. So I suppose they would have to have gone through that process in order to do what they did.
Right. Making those permit values, typically we would expect them to be higher. So, okay, that's fine. Now, something that you mentioned, and we've talked about this a bit, but just to refresh, you mentioned the factor back method. So am I correct in assuming that the starting point with a factor back method is to take post-reference rents and then to scale them back based on the permissible annual increases as prescribed by the rental tenancies branch? Is that correct?
That would be correct. Fully knowing that newer buildings or newly renovated buildings are exempt from rent control. So it's not a perfect system. It's just that's our way of trying to capture the market and recognize that based on a historical reference date, the newer building that didn't exist at that time probably would have rented for a little bit less. That's all.
Okay, but we can agree that we're starting, if that is the methodology the city's using, the very starting point is with post-reference material, correct?
Yes.
Okay. And further to that, and I've submitted this into evidence, but I think we've all discussed this a number of times. The rent increase guideline for properties that are indeed under rent control, for example, the permissible increase from 22 and 23 was 0% for each year, correct?
Yep.
Okay. Okay, so I'll leave that there, Mr. Chair. I think we all have gone through that discussion, so just refresher. In terms of the suite mix, Mr. Barocas, on page 3, well, hold on. Let's look very quickly at the rent comps, and I appreciate that you've recognized that the property on Austin is indeed not a market apartment. But let's look at 92 Princess. I don't disagree that it is similar, but it is slightly more amenity rich. But what I'm most concerned with is the mathematics here. There are 60 suites, 30 of which are 1 bedroom, 30 of which are 2 bedrooms. So we can agree that it's 50-50, 1 bedroom and 2 bedroom, correct?
Yep.
But our property has 20.51% bachelor units. So there's been no adjustment to capture the delta in the mathematics of the suite mix. And that would indeed, if we agree that a 2 bedroom rents for more than a 1 bedroom or 1 bedroom for more than a bachelor, then that would distort that number upward, would it not?
Well, I mean, when you look at the average monthly rent on the table, we're below all the comparables.
Okay, and then 165, that's the Porterhouse. Now that's interesting because it's where we have 53.85% 1 bedroom units. The Porterhouse is 88.24. But what I note about this, and I want to know if you're aware, the 4 units that are 2 bedrooms are actually townhouse style units. Are you aware of that?
Yes, I'm on the website right now. I see that.
And they're much larger, and they have separate entrances on Rory Street, correct?
Well, it's a corner property, so if that's Rory, then that would be
Yeah.
correct.
Okay. Okay, and then similar comment about the breakdown on Alexander. That one, where we have 25.64% of our makeup of our suites as 2-bedroom. That's the Bag Factory Lofts. Those are 70.45. So again, much higher propensity of higher value suites, correct?
Oh, well, I mean, if you're looking at the average monthly rent, we're about $1,000 less.
Right.
Or rather $100 less than they are. And I mean, we know what they're actually getting. And it does seem to fit the story that you're telling. If all else is exactly the same, which we know it never is, then the one that has more bachelors is going to command less rent on the market than 1 and 2 bedroom units.
Precisely. So I suppose presenting this chart without adjustment, that should be something the panel is aware of, just simply the mathematics of the suite breakdown, correct?
Well, yeah, but then you look at the average monthly rent per unit, we're at 1,086, and those other ones that don't have bachelor units, they're 1,200, high 1,100. So the result is, if I say the average monthly rent here was, like 1,200, then I'd be like, yeah, there's a problem, but we're lower, and we ought to be, and we are.
So for our subject property, what is the city suggesting an appropriate 1-bedroom rent ought to be per month?
We don't have it broken down like that.
Okay, so just to be clear, the city is not able to tell the ratepayer or the board the modeled rent per month for a bachelor, a 1-bedroom, or a 2-bedroom unit. Is that correct?
For this property specifically?
Yes, for this property specifically.
Well, there's other sources of income. So the average monthly rent per unit also could encompass laundry. It could encompass parking, encompass miscellaneous. There's a lot that goes into it and is taken into consideration. So we don't break it out per unit. All that's taken into consideration by the model and the mailers we get, and average monthly rent per unit is simply just the potential rent the model has assigned to the property divided by the total number of units.
I understand that, but because this was done, it was overwritten. I just, not to put too fine a point on this, Mr. Chair, but the city is not able to tell the owner what they're suggesting a 2-bedroom base rent ought to be in this property at this reference date. Is that correct?
We look at it as on a gross potential income basis on page 3. That's how we go about it.
Okay, that's understood. Now, in just one last question on this comp table. Now, you said that you had not visited this property, but the assessment department folks who did attend, did they suggest to you that the average unit size is 1,154 square feet, or did they make note of the very small units in this property?
That's just the gross floor area per unit. So that's the total building area divided by the number of units.
Okay, so the gross floor area would encompass then all common area. It would also include the office area, and it would also include the retail area. And that figure is simply divided by the 39 suites, and that's how you get to that gross floor area per unit?
That's as it would for all the other properties in our table and in other files that feature this column. So that's why I don't typically talk about it or put much weight on it, especially for resams where we both know that number might be inflated.
Right, and it's where it becomes interesting is if they're all indeed erroneous, then the ones that are resam, as you say, will have more area, let's say more square footage, and when we look at the porterhouse, which doesn't have that, you can see that the average suites are 846, and then some of these others are inflated. Okay, I wanted to just point that out very quickly.
That's why that's why the override is helpful.
Right, okay. Now these permits, I'll speak to those, Mr. Chair, in the next cycle, as I would ask the board to not consider them, as they are all indeed post-reference, pages 9 through 12, the assessor's brief. Or at least the values are post-reference. The physical change is not in dispute. Finally, Mr. Brokus, in terms of we'll call them the commercial leases, we've gone through a number of these buildings already, and Mr. Navarro has spoken to them, but one thing that's come up is the connectivity to the walkway. Can we agree that as a general principle, being connected to the downtown skywalk system would typically command a higher rent for either a retail or an office building in our market? Is that a fair comment?
It might. I know True North Square, their rents are significantly higher than this, and they're kind of more sectioned off. So it really depends on the quality of the location.
Okay, but fair enough. So 220 Portage, though, that's the RBC building. It's next to the Trizac or 360 Main, certainly connected. Is that fair to say that would be a vastly superior opportunity than our property?
220 Portage. It's got better exposure. Yeah, I'd probably say in that case it would be. I could see the argument for that.
167 Lombard is the grain exchange building. One of your comps there is very, very small at only 400 square feet. Again, that's a renovated heritage building in the central business district and certainly attached to the skywalk system. Is that your comment?
Again, I don't have the physical details of these comps. This is just a general list. Okay. So if you're looking for specifics, I can't really get into it with you.
Okay, well, okay, so that's fine. I won't belabor the point. But one thing that I did want to point out, 177 Lombard, that's the Chamber of Commerce building, correct?
I don't have that. I don't have the name of the building in my brief.
It's the one where there's a Salisbury house on the main floor and it faces onto the Richardson building. And it's not connected to the skywalk. It's a beautiful renovated heritage building, but those rents are both in at $10, correct?
That's what it says in my brief, yeah.
Okay, and the cap rates that you've used for for retail and office are simply model derived. Is that correct?
You got it.
And just like for the CC20, the model doesn't have capacity to make any adjustment for heritage, though, and I believe Mr. Mahone had mentioned in one of the earlier files that, and I agree that there should be some consideration for heritage in terms of the cap rate, but can we agree that the model does not have the capacity to make that adjustment for multifamily, office, or retail? Is my understanding of that correct?
I can only comment in regards to multifamily. I haven't seen that field, but in regards to the other sections, I can't conclusively say either way.
Okay, that's fair. And then page 19, this is an I&E from a different owner, correct?
Yeah, it's not really relevant to. I probably shouldn't have included it. I was just basically showing that what's there now doesn't line up with what's there before. So it's not anything that's should be weighed or even have any time taken on.
Okay. Thank you. Those are my questions, Mr. Chair.
Thank you. Ms. Nesbitt?
No questions. Thank you.
Thank you. Mr. Mahone?
I do, with respect to one of the ad at page 13, because there was a discussion about parking, and I see the ad refers to below grade parking. Is that not underground parking? And if so, is that attached or is that part of the building?
No, there's no parking on this building.
Okay, thank you. And the retail and commercial, if the ad is correct, is on the main floor of this premise of this structure? Is that?
Yeah, the main floor and partially in the basement as well.
Okay. Thank you. I have nothing further.
Okay, I thank you. Ms. Barocas, you had made a recommendation of, for the apartment, 5,032,000. Is that correct?
Yes, it is.
Okay. Mr. Story, are you in agreement?
No, sir, I would like to
All right.
proceed with our presentation.
I just wanted to get that out of the way. Okay. Mr. Story, we're ready for your presentation.
Wonderful. Thank you, Mr. Chair. Okay, so the properties we've established is 104 Princess. It is one of the structure is one of the older warehouse buildings in the West Exchange. I was able to visit the property either last week or the week before, and I was able to go through both commercial units as well as to go through the apartments. Saw a vacant unit and the amenity space, which indeed is the rooftop patio. Mr. Brooks has pointed that out. That is correct. He's also pointed out quite correctly that the office space is on the main and then in the basement, so below grade, and the retail space is now vacated. So it is, the present physical condition is that it is indeed vacant. So and I think that speaks to some of the challenges with retail in the downtown. But I want to let you know that that is the present physical condition. We are at the corner of Princess and Bannatyne. Again, the West Exchange. I had mentioned that this property was initially built in 1885. There was a fire in 1950, which took down about half of the property. And so the building where the apartment stands now, that original that is built on the frame of the building that was rebuilt in 1950. The city has applied an effective age of 1996. It's very difficult to square that because again, the bones of half of this building at least are indeed from 1885. Okay, so in terms of the rents, we've looked to other downtown apartments. We did not use a factor back method. We did not use any post-reference material in our determination of what the rents ought to be. For the sake of expediency, I'll show you that the first rental comp that we've used, the original age is 1907. This is the edge on Princess. It's right down the street. It's 4 stories. It has 49 suites. The city has applied an effective age of 1990. So that would be by far and away our best comp, though the suites are larger. You can see that the monthly rent for the suites are in line. They're about the same size. The 1 bedroom that I went through, it is indeed loft style. There's a main living room with a sort of a counter where your kitchen area is, and then an elevated platform behind a partition wall where the sleeping area is. So they're quite small, probably about 575 square feet for the 1 bedroom, which is in line with what we're seeing at the edge. And you can see that the December 2017, which is the reference period germane to our exercise today, the rents there were $750 to $799 for a bachelor, $850 to $1,050 for a 1 bedroom, and $1,300 to $2,000 for a 2 bedroom. Sorry, $1,300 to $2,000 for a 2 bedroom. So ultimately, in reviewing these downtown rents, these downtown converted warehouses, again, the first 2 are converted warehouses. They're very good comparables. Excuse me. Based on their initial age, based on the fact that they were indeed renovated. We've tried to put ourselves in the mind of a purchaser or developer, and what would be considered a reasonable rent at the reference date. So we've applied $775 for the bachelor units, $1,000 per month for the 1 bedroom, and $1,200 per month for the 2 bedroom. The expense ratio, of course, this is tricky because it is somewhat theoretical in that we don't have years of operating statements to stabilize and determine the appropriate expense ratio. We would expect something in the range of 45 to 50% for a new build, considering that it is built with very, very old bones from before the turn of the 20th century. So the city's application of 46.43 is accepted. It does appear to fall within what we would consider an acceptable range. Now, in terms of our cap rates for the group, the cohortship that falls between 1975 and 1997, we would typically apply a rate of 5.5%. That's supported by our cap rate study. You've heard it and seen it before, but ultimately our summary table is on page 8. We're suggesting 5.5%, but we do have to pay special consideration to the heritage designation, as well as the parking issue. It says here wood frame construction, but I don't believe that to be the case. I believe this building is brick with steel exterior, so please disregard that. But considering the age, the actual age, considering the heritage designation, and considering the lack of parking, we have adjusted our cap rate to 5.75. So that's 1/4 point above our 5.5, which makes sense. So ultimately, our NOI is calculated at 251,448, which is not worlds apart from the assessor's 264,180. But the big differentiating factor here is the cap rate. We are suggesting that 5.5 as a base for 1996 is appropriate, but considering these very, very site-specific factors, as I've mentioned, that a 1/4 point adjustment is indeed warranted, if not somewhat conservative. So that brings us to a overall value for the 2021 appeal, the 2018 reference date of $4,373,009. We of course round that to $4,373,000. So in terms of the office valuation, I've provided you with a number of rents here that are in the general area. There's a mix of main and upper. We have to consider that we have some below grade office, which is not completely typical, but sometimes when you convert a building like this, you have to make some adjustments. So we are cognizant of that, but we have not added basement rents. They would likely be quite low. Again, I was in the space. It is quite nice. I feel very confident in the table that we've provided here today. And those rents range from anywhere from $9.23 to $11.52, with an average of $10.79, a median of $11.11. So we've applied $11 per square foot net. Vacancy and shortfall are not in dispute. We agree with the assessor's parameters. Mr. Navarro did touch on the non-recoverable expenses. We have again supported our position that the 7% ought to be included. I provided you, I think we both provided you with our study, so I'm happy to go into that further, but I know that you've all heard it before, so I will just suffice it to say that we do continue to apply an allowance of 7% of the EGI as part of our valuation of the subject. In terms of the cap rate applied by the assessor has applied 6.75%. We have adjusted to 7%, which I think is quite reasonable. And that effectively is in line with our study that has been submitted to you as well. In terms of the retail, as I mentioned, the retail is now vacant. So when we're considering, again, when we're considering the non-recoverables, the owner will have a consideration towards space marketing costs as well as leasing commissions, and these are two of the major issues that come up with non-recoverables. So this is a good example of that being very germane to our discussion in the moment, quite frankly. The city has used 1677 for the retail. That's over 1,142 square feet. We have provided comparables that indicate a range between $11 and $15.30, with an average of $13.39 and a median of $14. So we think the rents kicked out by the model in this instance are a little bit high. So we're using $14 for the retail and again $11 for the office. Vacancy and shortfall, again, not in dispute. the retail item. The non-recoverables, again, we continue to apply 7%. And the cap rate, now this is very interesting. We're not disputing the cap rate on this income stream as it is 8.5%. That's quite high. And so we agree. This is somewhat of a challenging environment for retail, and we think the city has adequately captured an appropriate cap rate. So the cap rate is not in dispute for the retail component. So ultimately, with that being said, I've summarized the class code 60 calculations on page 12 of my brief. The retail valuation calculates to 157,580. The office portion calculates to 534,812, with a total CC 60 value of 692,392. Of course, we round that to 692,000. Which leads us to an overall indicated market value as of the reference date of April 1, 2018 of 5,065,000, with 4,373,000 being attributed to CC 20 and 692,000 being attributed to the CC 60. The balance of the brief is the city's workup. We have the building details, so you can see there. That's all included. I have some marketing photos. Again, these are staged marketing photos, but they do give you a sense of the general interior. Again, I did visit the suites within the last 2 weeks. And then, of course, the list of historical resources that starts on page 26 of my brief, and you can see that a grade 3 heritage designation is indeed we consider the most severe, I guess, for lack of a better word, of the grades. Grade 1 being most permissible, grade 3 being the least, and then some information about it's called the short form workup from 1983, when the property was added to the heritage historical resources list. And just as a final point, in 1983, the grading system was still being applied. When a property is added to the list today, they actually identify what are called CDEs, or character defining elements. So it's a little more clear for the owners as to what elements of the building are to be protected, whereas a grade 3 designation simply it's a little bit more, well, I'll say, nebulous to an owner. So ultimately, we do believe that the heritage designation ought to carry some consideration in the capitalization rate. It does increase risk. It doesn't typically increase costs over time for owners. So we do respectfully submit the value not exceed 5,065,000 for both income streams. And with that, I'm open to your questions.
Thank you, Mr. Story. Matthew, questions of the applicant?
Yes. So, your residential income, so on a per unit basis, your requested assessment works out to about 112,128 per unit. Does that seem low for what is basically newer? It looks like a new building and renovated older buildings. Does that seem low to you?
No, I don't think so. I'd consider that, but we're also, keep in mind, and it's always difficult when we're into 2023 talking about 2018. We're talking about the value as of 5 years ago, the economic conditions as of 5 years ago, and we're also talking about loft style suites. So I think yours is about 130 per door, and if I'm at 112, I think that's fine. I don't have any. That doesn't give me any pause.
All right, and so on your page 9, you added a cap rate premium based on heritage status, correct?
Precisely.
Okay, so, and that's based on anticipated difficulty because of said status to do work, to renovate, to, you said it was severe. Can you, like,
Sure. So, okay, so just we can, love to talk about heritage. There's a caveat on title when you have a heritage property. So when we're looking at the bundle of rights for the owner, the caveat on title is something that runs with that property forever, unless there is some extreme circumstance where the caveat can be removed. What that means from a very practical sense for an owner is that any sort of work that is permitted needs to go through a separate channel at property planning and development. That can include using only certain contractors for masonry, for example, for window work. If it's deemed by the committee that the work ought to be done to a certain standard that satisfies the sensitivity of the heritage element, that can be very, very costly versus going to the private market and having any, just any contractor do the work for you. So yes, in terms, and just so I'm very clear, we're very much champions of heritage, but we have to be reasonable and understand that the cost of maintaining our built heritage is borne by the owners, and it is an added cost, and it is unfortunately more time consuming based on the separate administrative channel that needs to be undertaken, and that's something that will run with this property for its life. So yes, it is a consideration.
Okay, and just if we go to, on that note, I'll go to page 19, please, of the Altus brief. There's basically what it is, it's a picture of the outside of the property. Might it be fair to say that what you mentioned in terms of the time and the time that would need to be spent to renovate, and the resistance the owner might feel ought to have already taken place given the magnitude of the renovation that happened? That'd be fair to say?
No, I don't think so, because I think there are going to be elements here where it's an unknown as to effectively the owner is at the mercy of the Heritage Resource Committee and what they deem to be appropriate or what is when they apply for a permit to do work. I can't stress this enough. It is a separate process. Our experience is that it takes longer, it's more costly, and it is something of an impediment to redevelopment. Now, I appreciate what you're saying. There has been redevelopment here, but if, for example, the owner wants to replace or do something with the windows, I've personally seen what that looks like on a heritage basis versus a non-heritage basis, and it can be very, very costly and very time consuming. The property also is brick, so if they need to use prescribed masonry contractors, that can be very costly as well. So to suggest that all of those costs are now sort of put in the wind and forgotten, I think that's completely incorrect. I think that carrying this heritage designation, there should be some expectation that the costs will be higher than they would be without that designation going forward.
All right, those are my questions. Thank you.
Thank you. Ms. Nisbet?
I just have another question related to the heritage.
Sure.
Is not a portion of that cost goes to rent? Like, wouldn't the owner actually kind of maybe charge a little bit more rent in order for these?
Interesting. Yeah, so I mean, obviously because the property is not under rent control, theoretically the owner can charge whatever he likes, but the other side of that street is the market will only bear so much. So certainly they can try to recoup some of those costs, but that and certainly from either the CC60, all the commercial stream, or from the residential, but from my perspective at least, that puts the owner in a less competitive position. versus the the properties down the street who don't have to try to generate income over and above what we'll typically call
So
market.
it's probably a different quality of property too, in that it's new. And everything
Newer,
else,
yeah.
and somebody might want that.
Yeah, well, many of the, actually, to be fair, many of the loft warehouse redevelopments, they have a similar kind of character to them. So they're new, but they're also part of their charm is that they're old. They have exposed brick and that type of thing. So but yeah, that's a fair comment.
So the designation though has been in place for many years.
Since 1983, as far as I can tell. Yeah.
Okay, and that designation obviously didn't stop the owner from
No.
demolishing, reconstructing, reconfiguring.
Don't know how much demolition there was there. I believe they built atop the 1950 warehouse. So this one, so this is, we know this is
Can I-
Fairchild
can you
Law.
direct me to a
Oh,
page?
sorry, yeah, page 19. The one with that sort of
Right, I see.
rusted steel, they built atop that one, but this is the original 1885 building.
Okay.
So that's not been demolished. This is Fairchild, which is a wholly other property, but this is the property that was built, it burned down in 1950 and then was rebuilt, and this is the one where there's been substantial change.
Okay, the
So-
1950 portion.
Yeah, and they're both on the same, they have a adjoining party wall and they're both built on the same foundation.
Okay. So the original piece was also significantly reconstructed, like within.
In
Then it's
1950.
in the original. Not the middle,
Right.
not the new, the other part.
Well, this was sort of gutted and renovated,
Okay.
but in a historically
Right,
sensitive fashion. Yeah.
right. It had to meet the specific criteria of the designation.
Yeah.
I understand that part. Okay, all right. I have no other questions. Thank you.
I thank you, Mr. Mahone.
And just a follow-up with what Ms. Nesbitt was saying with respect to the additional costs for the heritage designation. Some of those will be captured as well, will they not, in the expense ratios?
Oh, well, yes, they should be, but this expense ratio that we're using today, just so we're clear, we're not double counting or double counting the cap rate to the expense ratio. A property with where the structure is predominantly from 1885, we would expect to see an expense ratio in that 45 to 50% to be certain. So it's not as though we're using a 65% ratio and or 60% ratio or something like that in a higher cap rate. So the expense ratio, which again is modeled because we don't have the ability to employ our typical technique of taking 3 years and stabilizing into a typical year. For lack of better information, we're accepting the 46.34, whatever it is, based on the fact that if this building did not have heritage designation, that is precisely what we would expect for a property of this age with that that was converted.
So there's pluses and minuses. Because this has been completely renovated, the actual expense ratio may be slightly less, but you're prepared to accept the cities because of the future expense ratio potentially being higher.
Well, for a time, I think you're right. For a time, we would expect the expense ratio to be lower for a time, but stabilized into the future, we would not expect to see it below, say, 50%. But yeah, I appreciate your comment. Yeah.
And what is the effective lifespan now of the renovated building? Can you?
Yeah, that's a great question. I'm not I'm not an engineer, so it's hard for me to say. But certainly they've breathed new economic life into it. But I've not seen anything regarding condition. I would presume that it's good for a while, let's say. But ongoing maintenance is a sort of a natural fact with these older properties, and that's with any older property you would expect a higher degree of maintenance. Based on the fact again that let's say the bones are from 1885. So
Okay. My last question is with respect to the effective age. The cap rate that you have used from your chart is for an effective age between 1975 and 1997, and then you've added a bonus for the heritage designation. What effective age, or can you be more specific on the effective age? Anything besides
Yeah.
the 2-year span, and second part, how did you arrive at that effective age?
So the effective age is actually, we don't typically quantify an effective age in our analysis. That's from the city. But we are looking at it and saying, well, if our cohortship is, bifurcated between this 1970 to 1999, that seems to be where it would fall. So it's not a real point of contention. There is some question of it is discretionary. So it is someone's opinion from the city who's applied that effective age. But ultimately, yes, we don't wholly disagree with the idea that now it's, they've breathed 100 years of life into it by doing substantial work. That's not in dispute. And just to be clear, the adjustment or the premium to the cap rate that we've applied is for the heritage designation, but it also we also consider the fact that the property has no parking on the multifamily stream, and that is, as you can imagine, Mr. Baroque has quite rightly said that that's now a missing line item from an income statement, and that will be true going forward. So in terms of the durability of the income, or for the capacity for the asset to command a greater deal of income, typically we would expect properties that rent on the higher scale to include parking. So having no parking is an issue, and it's not simply whether it's in the suburbs or downtown. Having no parking is a negative factor, to be certain, and coupled with the heritage designation, I think the 25 basis point adjustment makes sense.
Thank you. I don't have anything further.
I thank you, sir. Mr. Barocas, summation if you want.
I'll save it for the end of 2023. Thanks.
All right. Mr. Snorri, summation?
No, I think we'll just start.
Yeah, let's go to the last one, which is Mr. Barocas, the year for 2023. Floor is yours, sir.
Thank you. All right, same property, file number 22-4832, roll number 13060980100, 104 Princess. So we're just looking at the next cycle here, which is an effective date, April 1st, 2021. It's the same property physically.
I was just
Yep.
wondering that that's the wrong number.
Oh, yeah, there was this thing. Can you tell me what the number is so I don't have to take 30 seconds to dig?
So it's the file number was 23424.
All right, file number 23424.
Yeah.
So it's the same property, same roll number, physically same, just reference date of April 1st, 2021. So we'll go to page 3 for the new income valuation for this reference period. The average monthly rent $1,135.21 with a 5.15 cap rate for the apartment, generates estimated market value of $5,275,000. I actually think our gross potential rent is lower than the applicants. I don't see that being much part of the discussion. The rest of the parameters are modeled, and then you can see the breakdown on the retail and office standpoint. These are all modeled. 7.95 cap on the retail, and then the office we've got the 6.75 cap as well. Next page, we've got the overall summary of the square footages for the rates and commercial and residential classifications. Rent comparables on page 5, so you can see that we fall below the rent comparables in the Exchange District area. We've got a couple more that do have bachelor units, including 98 Market. 316 Ross only has one, so I don't think that weighs too much on its respective average monthly rent per unit. Comparable leases for this go around on page 6 as well. So they range in the $16 to $22 range. And then on the next page, we've got our cap rate evidence. I'm sure you're all familiar with this table at this point, so I'm not going to repeat myself because I'm sure you can remember what I said 2 files ago. And then we've got our overall cap rate table on page 8. And then the same permits flow through page 13. They spent $34 million on it on the cost report. And then we have the same ads and photos as before. That's my evidence. Thank you.
You, sir. Mr. Story.
Yes, sir, thank you. A few questions, and I'll ask that many of the questions and our discussion carry forward from previous file to this file. Mr. Barocas, I'm looking here at your modeled retail and office cap rates. I'm looking at the cap rates. Are those modeled, those cap rates?
Yes.
Okay, and I noticed that the retail dropped by 55 basis points. Is there any reason why, in your mind, the model would suggest cap rate compression in the downtown in the middle of the pandemic at April 1, 2021? Should that not be going the other way, or at least staying static?
I don't have any information in regards to the cap rate compression in my brief.
Okay, and same question for the office? Is that same answer?
I don't have anything more than to say that it's the model. We got the income and expense mailers, and we've got a table of the ranges. Outside of that, I can't really comment too much.
Okay. And our NOI is Altus NOI is higher for the apartments. So I'll for the sake of expediency, I'll presume if there's no dispute there with the city. But in terms of the apartment cap rates for this reference here, is it modeled or was that adjusted?
That's modeled.
That's modeled. Okay. All right. And then just very quickly, in terms of your commercial leases on page 6, did you have the chance to review these to ensure that they were indeed net rents as opposed to gross rents?
I mean, they were entered as net rents in our model. I didn't go to the individual income and expense mailer. So I'm operating on the assumption that they are net.
Okay, and just for the panels, so you're not aware then that entries 1 and 3 are indeed gross rents that are recorded here?
I don't have anything in my brief to indicate that they are.
And okay, and the 179 Bannatyne, are those restaurant rents?
I don't have the tenant, so I can't.
And I presume, and correct me if I'm wrong, you wouldn't be aware that 123 Bannatyne is not indeed an arm's length lease. Is that fair?
If you've got something in your brief that can confirm that statement.
Well, I can certainly speak to it. That was the property was, or the tenant is a tech firm, let's say. That's the building where MMP architects are. The building ownership shares common ownership with the architecture firm. The principals of the building ownership group were the principals of the tech firm, and those leases were established in conjunction with the sale of the business in 2019. And that was, and the city would be aware of that because it was in Altus evidence with relative to either the 2020 or 2023 appeal of that property. But that didn't presumably come up in your research on that comp?
Do you have that in your brief somewhere?
No, I'm submitting it verbally.
Okay.
Okay. Okay. Now let's talk quickly about these permits that were post-reference. This is fine. The one thing that I found very interesting this cost report, and you've said a number of times now that the total is $34.6 million. Did you add up these inputs?
This is what the owner reported.
Okay, but just because it's in evidence and you've mentioned it, would it surprise you to know that total comes to about $5.4 million when you actually add those inputs in?
I didn't have the time to go line by line. I just took
Okay.
what they said.
Just so the board is aware, it comes to just over $5.4 million. And of course, some of these inputs might not be included in a cost approach. Is that fair?
Well, 5.4, that's pretty close to what we're assessing the place for.
Right, and there's 700,000 in general conditions. Would that be included in the cost report? In the cost approach?
We're not doing a cost approach.
Right, but you've submitted a cost schedule here, and further to that, if you were doing a cost schedule, there would be some consideration for depreciation, would there not?
Yeah, that's part of the cost approach.
Okay, I think those are the balance of my questions, Mr. Chair, and again, I'll just ask that the questions that are germane to both files just be carried forward, and thank you.
I thank you. Ms. Nesbitt,
No questions.
I thank you, Mr. Mahon.
No, thank you. No questions.
Okay. Mr. Story, your
Yes,
floor is yours.
thank you, sir. So we'll start. We've established got a pretty good handle on where the property is and the history. So I'll jump right into the multifamily. Now, in terms of the NOI, in this case, we were able to take the rent roll with expected rents. Now, I do note that they may be a touch high. Their expected rents, they don't consider discounts and they don't consider incentives like move-in bonuses, but to be very, very to take a liberal approach with the expected rents, we have we have discounts, but we don't have inducements. But we've taken the September 2020 rent roll, multiplied it by 12. We've used a 7.5% vacancy as per the Collier's report on new product. They're suggesting 7.4 is appropriate for new product as of this reference date. But ultimately, our NOI is just a touch higher than the city's. So we've applied, again, a capitalization rate of 5.75 as per our cap rate study and as per the brokers researching the multifamily universe. We see cap rate compression in multifamily between the two cycles between 0 and 25 basis points. So we've been very consistent. We suggested 5.75 in the previous cycle, and we're suggesting 5.75% again. And again, that is based on the fact that our research and the research of the brokers suggests that the appropriate cap rate compression between the two cycles is between 0 and 25 basis points. Ultimately, then our value for the apartment income stream comes to $4,785,776. We then round that to $4,786,786. In terms of the office valuation, we've again provided you with a number of net rents. You'll recall that we had applied $11 in the previous. We're now based on appreciation to those to some of these face rents, though face rents in office has typically been flat cycle over cycle. We have applied $13. It is a newer reno, so we have applied some escalation over the previous analysis. Vacancy is not in dispute. Shortfall is not in dispute. Again, the non-recoverable expenses. Mr. Navarro quite rightly noted that the city had applied 2% in the previous cycle, 3% in this cycle, but for the 20 or 25 years prior, they'd used 7%. We continue to use 7%. We have not seen any compelling evidence from the city to indicate why that ought to be removed as an allowance from our from the analysis. In terms of the capitalization rate, we've provided you with a bit of a summary here. But we are applying a cap rate of 7.5%. We think that that's commensurate with this property. And so we think that makes sense. Mr. Navarro has gone through the office caps in great detail. 7.5% makes sense from our perspective. In terms of the retail valuation, the city has used $14. At the time of writing the brief, there was some, this property was subbed twice. So at the time of the initial brief writing, we were not aware of the city's net rents, but we had applied $14. And once again, we've provided you with a schedule of rents ranging from $12 to $15 with an average of $13.60 and a median of 14. So we've applied $14. Vacancy and shortfall is not in dispute. We continue to apply 8.5%. I mentioned previously that we were in agreement in the previous cycle with 8.5% on the retail. I noted again that the space is currently vacant. That's the present physical situation at the property. So it doesn't make logical sense that in the middle of the pandemic, the downtown retail would be experiencing less risk, let's say. In fact, it should maybe be higher, but 8.5 is at a very high end of the scale. So we've continued to apply 8.5 as we did in the previous cycle. All that to say that our retail income stream is then calculated to be $229,260, with the office income stream calculated to be $585,937, which we then round, giving us a total requested assessment of $4,786,000 for the multifamily, and $815,815 for the retail and office. And the balance of my brief is some of the material that you've seen before. There's a rent roll in here, but again, these are mostly vacant with expected rents. And we had used that, though. It may be why we've come out a little bit higher than the model, but overall, I'm comfortable with the ultimate value that we've come to today. And with that, I'm open to your questions, and I thank you.
Thank you, sir. Mr. Rox.
Okay.
Mr. Sorry.
I asked my questions in regards to the heritage apply to this file. So if we can go to page, let me see, page 15. We've got some recent office property sales. One of them is actually 433 Main Street. And it was classified as a B- C+ at the time of the sale. Is that correct?
Yeah, that's what we have here on our schedule. That's correct.
But then for the previous, when we under appeal, it was a C. Could you an OFC? Can you explain that a little bit?
I'm sorry. Are we discussing Princess Street or 433 Main?
Well, I'm just curious about 433 Main. It's in your brief here, so I'm just asking some questions about it.
433 Main as a cap rate comparable? Sure. So when you look at the, I believe it's called the coach report, where they discuss the elements, where how you determine what is a class B or a class C. I don't have them in front of me, but I know that the floor plate, now losing a huge amount of floor area would bring that, would downgrade that rating. Lack of amenities, lack of parking. There's some consideration for building security, on-site security and caretaking and management. So that building changed. So if they're saying that prior to renovation, it was a soft C or a soft B or a strong C, I see no issue with that. But again, I don't want to cross streams here. We're talking about 104 Princess. But
yeah, for sure. I'm just curious because on the page 13, you said that the survey indicated that 57% of respondents expected office tenants to downsize their space in the future based on the pandemic, based on work from home. So it seems like you're almost saying two things. It's like you're saying, oh, it was better when it had more office space because there was more floors and it was a B then, but then they got rid of all this office space and now
Well,
it's a C.
I'm
But
not aware.
at the same time, you're also commenting on how that's what everybody is doing
No,
to
no.
move with the market. So I'm a bit confused on how those two
Okay.
comments dovetail together.
I would suggest to Mr. Brokers that you'd be very hard pressed to find a Class B office that is predominantly an apartment building. So we're talking about a conversion, right?
Class B office space, not because it's like a building
Right.
within.
Okay, and so we all know the passport office where you stand in line and go downstairs and get your photo taken. They've been there for many, many years. They downsized their space. So actually what we're saying is makes sense in the market, but for that specific file, it also makes sense. So I'm not sure where the confusion is. If that property was seen to be a better had a higher and better use as a hybrid office apartment building, then that's fine. I'm not sure what your issue is. When it's sold, the implied cap rate was 7.66%, and that's pre-pandemic. That's in 2019.
All right. Well, I'm not sure if I'm quite clear on that, but that's fine. In regards to your overall cap rate, you mentioned there was compression, yet you didn't change the residential cap rate from 5.75 from the last cycle. Why not knock it down to 5.5?
Right. So what I mentioned, I thought I mentioned a number of times, was that the cap rate compression in multifamily, as indicated by the brokers and as indicated by Altus Research, was that the compression was between, depending on which brokerage you're looking at, is between 0 and 25 basis points. So looking at this property on a site-specific basis, I don't necessarily see any indication that there should be cap rate compression. The other in our cap rate study, which again is rather fulsome, we talk about the changing tenant preference at the reference date. Obviously, this is COVID has something to do with this, but we do see a change in preference towards larger suites, more amenities. And I would suggest to you, Mr. Brokers, that part of the appeal of a property like 104 Princess is being part of the life of the cultural hub of the downtown. And when everything's closed, that becomes very difficult. And the suites are small, and the amenity space is simply a rooftop patio. So looking at it on balance, I believe that if the appropriate cap rate compression is either somewhere in that range of 0 to 25 basis points, I feel very confident that that the cap rate should be static, cycle over cycle, with that specific asset.
All right. Those are my questions, other than summation at the end, please. Thank you.
Thank you. Ms. Nesbitt?
No questions?
Okay, I thank you. Mr. Mahone?
No, I don't have any questions. Thank you.
Okay, I just have one. Mr. Story, your page 20. You refer to the summary and you have a property located at 2525 Pembina Highway.
That's a typo.
Okay, obviously.
Apologize for that. Yeah, you caught me.
Okay. That's all I want to
Sorry about
mention. Mr. Baracus, summation if you wish.
Yeah, for sure. So on this property here, 104 Princess, we have a slight compression from my recommendation, pretty modest, from 2021 a cap rate of 5.25 to 5.15. Everyone knows what happened to the interest rate and the cost of money to borrow in order for real estate investors to get in on these type of projects. More money over a known NOI, more money available equals more competition, higher sale price, lower cap. So it doesn't make any sense to me how a cap rate would stay the same when the interest rate plummeted as it did. I know there was a discussion upon heritage look at the pictures in my brief, look at the pictures in the applicant's brief and restrictions in regards to what could be done. It doesn't look like they had any problem whatsoever knocking down half the building, building a completely new loft style apartment with commercial on it, and slapping on 2 floors to the other one, the other existing building. So it doesn't look like they're having any problem whatsoever redeveloping the exchange in that manner. So I don't see, it doesn't make sense how in this instance why heritage would be an impediment, because by the looks of it, it wasn't, and all that's already been done. Those hurdles have been cleared. So what's the problem is what I'm saying. On a per suite basis, the city assessment for 2023, 5275 divided by 39 is only 135,256 per unit. That's nothing compared to newer units outside of the downtown core. And you're getting either a new build or a fully renovated loft style apartment. So it just seems illogical to me why it ought to be lower for those reasons. On the residential side, that's my evidence. That's my summation. Thank you.
Thank you, Mr. Baracus. The boys from Altus, summation.
Very quick summation, Mr. Chair. Thank you. So there's an interesting comment about the interest rate. As we all know, during the pandemic, the interest rates were adjusted by emergency measure. So to suggest that the brokers did not consider that would be completely erroneous and misleading. So I want to point that out firstly. Secondly, all of our inputs, our positions here today are well supported by studies that we've provided to the board that I believe to be rather fulsome. That should answer any questions regarding our methodology, our cap rates, any number of the inputs that we've looked at today. We've provided you with lease comparables that are net leases that are fully researched. We haven't provided you with gross leases that were erroneous. And then further to that, the info on non-recoverables in the first hearing, or the first file that came up, the assessor noted that they have no info on non-recoverables in their brief, and they have no info on the cap rates. Mr. Navarro rightly pointed out that clearly the onus is on the assessor, and I frankly don't see anything that supports their position. Now, further to that, and just as a final point on this, I think we're mostly aware that heritage is a unique proposition for a developer, and there are indeed ongoing costs to renovate, to maintain, and if the department doesn't recognize that, we have to have these sort of hearings and have these discussions. But we've learned today that the model doesn't have capacity to adjust those things, and the assessor has simply suggested that because the property is now built, it will not have any kind of ongoing maintenance. That's simply not correct. So we would suggest that based on our submission here today, Mr. Chair, based on the all of the research that we've provided to the board, that our positions be given weighted consideration. And then just finally, so I don't forget, this method of factoring back rents, starting with post-reference material, is wholly inappropriate, should not be considered. So in terms of the NOI for the 2018 reference year, I would ask that that method not be accepted by this board, as it is not within the bounds of what we're set here to do. So with that, I thank you for listening to our presentations, and I'll stop talking. Thank you very much.
That's right. Thank you both for your presentations and results very soon. Mr. Baracus, thank you very kindly. We have heard all the scheduled items, and this hearing is now adjourned. I thank you.
Thank you so much.
Have a good
Thanks,
day.
You too. Have a good day, everyone. Enjoy the rest of your.
Have a good holiday.
Thank you. I will.
I know.